Well, tighter financial conditions in the wake of the collapse of Silicon Valley Bank, as we were hearing earlier, and Credit Suisse's takeover seem to be weighing heavily on central bankers when they made their latest rate increases. Professor David Blanchflower, Danny Blanchflower, is a former member of the Bank of England's Monetary Policy Committee, which sets interest rates. Danny, welcome back to the programme. Well, look, inflation is rising. Raising interest rates is presumably a sensible, a wise move.
Absolutely not, I'm afraid. Well, what your very good report from your correspondent there, what we've just seen in the last 2 weeks is very significant financial tightening in the world, which is basically equivalent probably to 150 or 200 basis points equivalent of raising interest rates. And the forecast is that, yes, inflation is quite high now, but it's going to plummet just like it did in 2008. So I do think that despite the fact that Powell and Bailey at the Bank of England are saying, yeah, this isn't the end, we're going to raise rates, that's not going to happen. I think what you're going to see is this tightening is going to generate very bad data. The banks, there's obviously issues in the banks, which we can talk more about. But I think this is extremely misplaced rate rises. It feels very much like 2008. And basically the same people today saying you've got to raise rates and you've got to worry about inflation were the same people who said the same thing in 2008 and missed the Great Recession. So for your listeners, stand by about turn coming, screeching handbrake U-turns coming.
Okay, a screaming handbrake U-turn. I mean, in simple terms, what are the consequences of today's decision for folks around the world who have mortgages and loans?
Well, it's going to slow the economy more. I mean, for people on variable rate mortgages, particularly in UK, where they're resetting their mortgages, and for firms especially, and for banks who are holding mortgages, what you're going to see is restrictions on lending. Particularly think about the bond holders who were wiped out in Credit Suisse. That means people are prepared to lend money in bonds. People who are prepared to do that have to realize that there's a much greater risk, so they're going to want higher returns to that. Banks are going to be more tighter, if you like, in who they lend to. So this is going to slow the global economy. And the Bank of England, for example, is actually forecasting that. It's actually forecasting, even with the rate rise, 3 years of no growth at all, and that's probably optimistic. So I think what you see here is banks, central banks making errors. The consequences on ordinary people is recessions are coming. Times are tough. It's going to be more expensive to borrow. And what we're seeing around the world is consumers are retrenching, particularly workers who see that their real pay is falling. Wage increases are not as high as inflation is, and living standards are falling. That's bad for firms, bad for economies, bad for central banks who have to reverse all the stuff that they've just done.
Our very rude correspondent John Terrett suggested Jerome Powell was boring on far too long and talked too much, and that was a problem. I mean, Jerome Powell did say that the US banking system in that very long speech was sound and resilient. Do you agree?
Well, he has a little problem, though, which is the other most important figure in US economic policy was Janet Yellen, who actually cut underneath him completely and said that the government would not be bailing out and guaranteeing deposits of the regional banks. Well, that looks like that had a major effect. I mean, the danger there is if people have got to save $10 million in a regional bank, basically Yellen said that's not guaranteed. So what people should do clearly is take that money out of a regional bank and move it to a big bank, move it to Bank of America, move it to JP Morgan Chase. Well, that's a bank run. So Janet Yellen misspoke, probably should not have said that. It looks like you're going to have to guarantee deposits in the United States. So this thing is unfolding. We certainly don't know what these risks are. UBS had to get paid 9 billion Swiss francs because of potential losses it was going to find when it opened up the hood of what was under Credit Suisse's book. So this is all unclear, but all the risks are to the downside. The risks are more to recession than they were. But yeah, Jay Powell, I mean, I call it guessonomics and wishful thinking. He says, we're going to raise rates, it's going to be fine. But what he's really doing is standing there going, hope, hope, fingers crossed, hope. And the likelihood is he's going to be undercut by events.
The ECB is watching the banking turmoil unfold, but says a full-blown crisis is so far unlikely. I mean, look in the Danny Blanchflower crystal ball. What is likely?
Well, I mean, I look back at two things. Well, Trichet said the same thing in the ECB in 2011 and raised rates twice. That was a mistake. We look back at Northern Rock and Bear Stearns in 2007 and 8, and Northern Rock was more or less like what happened to this Silicon Valley Bank, where you had to guarantee deposits. But what did it do? Did it stop contagion? Well, no, it didn't. We saw that this spread around the world. Central banks didn't manage to stop it. So in Britain, there was Northern Rock with a model. Also, the same thing applied to Bradford and Bingley and Alliance and Leicester. And a few months later, they failed. RBS failed. So the ability to contain a financial crisis by saying, oh, it's fine, it isn't really there, shouldn't really inspire people to think these folks have what they do, or know what they're doing. And if you have, the chairman of the Fed saying something almost entirely different to the Secretary of the Treasury, we have some problems of coordination. So I think the ECB is, once again saying oh, we're hanging on, although the Guard did say, oh, we stand ready to reverse course at any time, which it's not if, it's just when they reverse course, I would argue. And these folks all got it wrong in 2008, and they're going to get it wrong again. Sorry.
Danny, on that cheery note, we must say thank you, goodbye. Come on the show again. Good to see you, Professor Danny Blanchflower.
Yes, sir. Thank you much.